Hey everyone, one of my greatest challenges when I shoot these videos each week is providing national level insights that hold true across most metros and property types. But by the same token, we also know that each metro and each property type faces a unique operating climate. I mean, if you think about it, the US economy is enormous. As of 2024, the US economy was bigger than the next three largest countries combined. If you add the 2024 GDP of China, Germany, and Japan together, they're still smaller than the US economy. And even at a state level, the economies are significant. If they were countries, California would be the fourth largest economy in the world. Texas would be the 8th largest, and New York would be the 9th largest economy, just ahead of Canada. Florida, Illinois, and Pennsylvania would also rank in the top 20 largest economies in the world. So talking about the US as a whole often overlooks regional and local economic and commercial real estate nuances. This week, I'm going to try to drill down a little bit and focus on what's happening with rent growth. And I'm going to compare the rents in the first quarter of 2025 versus the average rent of the last 3 years, 2022 through 2024. And I will start with apartments. In the first quarter of 2025, the average apartment rent in the US was up by 1.2% versus the 2022 to 2024 average. But there's an enormous range at a metro level. Apartment rents in Chicago are up by 6.3% compared to the 3-year average. Milwaukee is up by 5.3%, Cincinnati is 5.1% higher, Cleveland has posted gains of 4.9%, and Kansas City is 4.7% above the 3-year average. These are all metros that didn't have fantastic economic growth profiles over the last few years, but they also had very modest construction. At the other end of the spectrum, strong growth markets that had disproportionate construction levels have apartment rents that are below the 3-year average. Austin is down by 7.4%, Phoenix rents have declined 3.9%, and Atlanta is 3.7% below the 3-year average. Now, these metros are still growing and their long-term prospects remain sound once they absorb their supply overhang. But I wanted to point out that even though the Sunbelt metros had the strongest economic growth profiles, they still face unique local performance headwinds. Meanwhile, markets in the Midwest that didn't have outsized economic growth still performed quite well over the last few years. That reiterates the need for investors to look past the headlines and drill down into local market trends as they define their investment strategies. Now, looking at multi-tenant retail, the national average rent is 3.6% higher than the 3-year average. There's been very little multi-tenant retail construction, so the growth markets are generally favored. New York City had the strongest multi-tenant retail rent gains, reflecting that city's revival in the post-pandemic era. But that's followed by the growth markets of Miami, Las Vegas, and Charlotte, then by northern New Jersey and Salt Lake City. As for office, nationally office rents are up slightly, about 0.75% compared to the 2022 to 2024 average. But I think the top performing office markets are particularly interesting. I mean, most people think office rents have cratered, but Boston office rents are up by nearly 7% compared to the 3-year average. Miami rents are 6.5% higher, while Kansas City, northern New Jersey, and Fort Lauderdale are all about 3.4% higher than the 3-year average. So my point this week is that while the big picture trends are absolutely relevant, when it comes to commercial real estate investing, local trends can be even more significant. And sometimes the markets that look like they have the strongest outlook attract so much attention that the individual asset performance can be weakened by a flood of capital moving to the same place at the same time. When capital converges on a metro, real estate prices can be bid up, yields can compress, and the risk of overdevelopment rises. By the same token, opportunities can emerge in metros, submarkets, and property types that may be out of favor or are overlooked by other investors. So, contrarian strategies can deliver outsized returns for investors who do their homework, dig below the surface, and as always, keep their eyes on the horizon.